Good day to all. This is our second part of our discussions involving introduction to financial management and utilizing the same source. We will begin with business organizational forms in the US. Actually, this is a discussion that is discussed a lot of times in management and business subjects. So overall, this is just a review. For sole proprietorships, we have to take note that there is just one owner who is called the owner or proprietor. And then this is easy to set up as compared with other forms of business organization. And whoever will be the owner will be taxed personally with respect to the income obtained from that particular business, which is a sole proprietorship. Now, the disadvantage is that there is unlimited liability in cases that the business will have liabilities, then the owner will be solely or will be individually and personally liable to the creditors. In terms of profits and losses, the proprietor will have to enjoy the profits but bear with the losses. Enjoy the rewards but bear with the risks. The business has limited life on the sense that if the business will be losing a lot and the owner will be deciding to stop the business, so of course the business will have to end. And then this is difficult to transfer since this is unlike with the corporations wherein the interest or the shares can be transferred. So that's the first one. Next is partnership. There are two or more business owners called partners. And then because they are partners, therefore they are liable for every partner's actions, but within the authorities of the business. As compared to sole proprietorships, this is much better because I said two or more brains or two or more minds are better than one. On another hand, this is for US though, there are the so-called limited partnerships, which is emphasized here. In the Philippines setting and discussions, normally we just limit with partnerships. However, this is very true that there are actually types of partnerships. One is general, wherein all partners are called general partners, wherein they are to be liable and the creditors can be collecting from them individually for the entire debt of the business. So there is unlimited liability for general partnership. On another hand, in limited partnerships, there is just a requirement that there has to be one general partner who will be liable for all the obligations of the partnership or business. And then the others can be the so-called limited partners, wherein they're only liable or they are only obligated up to the extent of their capital contributions to the business. And therefore, they are not liable personally with respect to the debts of the partnership. Then there is limited liability of the corporation, which is similar to limited partnership. That's why if we say partnerships, normally we think of the general partnerships. Then that's for partnerships. And the business will have to be taxed on its level. So normally that is going to be same as corporations. Then corporations, these are the most common organizations found anywhere in the world with respect to partnerships versus corporations. But if we take into account sole proprietorships, well, sole proprietorships will have the most number. So this is the legal entity with all the economic rights and responsibilities of a person. And then, well, the start, which is the incorporation of the business, will have to be applied for. So there is a requirement under the law, the Corporation Code of the Philippines, and a corporation has to abide or follow that before it will be given the right to operate by the state or the charter or the government. So the incorporation starts at state level, and this is based on state law. The strengths would be that there is limited liability for the investors, and then there is actually before 50 years in the Philippine setting though for the life, but it can be renewed for another one. So in that sense, there is a limit. However, the life overall would be unlimited, especially like in that sense. But nowadays, the corporations can exist indefinitely, so without the need for renewal under the revised corporation code in the Philippines. So you can read about that more in the corporation code. Now, this is the finance function in the organizational structure of a typical large corporation. So at the onset, there will be the so-called incorporators who will be starting the corporation. So they're also shareholders because they have to own at least one share to start the business, at least five, but not more than 15. And then they will become stockholders or shareholders. Then they will have to elect the so-called board of directors or BODs who are to manage the business primarily overall or at the top. And then they are, in other words, the topmost managers of the corporation. And then there are also normally stockholders or owners. Now, the board of directors, of course, will have to elect the officers for the corporation. And then these officers will be recruiting employees then. So if you can notice, we have the president, the officer, who happens to be also the chief executive officer, which is the normal case. And the normal case also will be that the chairman of the board of director is the president, meaning an officer, and also doing a function, which is the chief executive officer or CEO. CEO, by the way, is a position. Presidency is, of course, an officer position. The CEO is a position also, but that is in terms of a function in the business. So this is already the managerial level at the top. The board of directors, by the way, are on the owner's level. So within the realm of the stockholders. Then under the president will be the VPs or vice presidents of the different functional departments. Then under the finance, we have the treasurer and controller. How do they differ? The treasurer would normally be focused on the assets or economic resources of the business, so how they have to be managed. But the controller normally would be focused more on financial accounting and reporting and the records keeping, especially for financial accounting purposes. So that's why we have under the treasurer the capital budgeting manager, then cash, credit, and foreign exchange. So basically, these are items involving the assets of the organization. We also have the debt and also the credit aspects. So both assets and liabilities and the equities will have to be considered by the treasurer in terms of financing or getting money. And then the next one, allow me to minimize that. So we have for controller, again, reporting, financial reporting, and so on, financial accounting items. We have the cost accounting, tax accounting, and financial accounting managers. Basically, they are the managers here. So this is the typical setup of the organization. Then for corporations in the US, sometimes there would be the double taxation problem. This is also applicable in the Philippines, that the taxation of the corporate income could be taxed at the company level, of course, for the net income, and also at the personal levels. And this is the single greatest disadvantage of the corporate form. Actually, there are a lot of disadvantages, but this is just, or this is actually one of those single greatest disadvantages. So, well, in that case, because it seemed that there is double taxation, but that is indirect, because the income of the corporation will have to be taxed, and then the personal levels, meaning the income like the dividends of the shareholders. Then the Jobs and Growth Tax Relief Reconciliation Act of 2003, anyway, this is in US again, dramatically reduced the double taxation problem. In our case, in the Philippines, well, we have our laws also, especially the revised National Internal Revenue Code or NIRC, which is our taxation law sets or programs in the Philippines. Now, for taxation of business income for corporations and partnerships, well, for the partnership again, it will be taxed also with its income. So net income actually then to be deducted with our income taxes, and that would result to net income after tax. Then from there, from the net income after tax, the government will have to be paid first. Then such will be distributed to the partners. So sharing of profits and losses. And then if there are any distributions, like for example, the partnership distributions, dividends are for corporations anyway, so that will also be taxed. And therefore, what will be obtained by the partners will be net of the tax as well on the personal level. So we have a tax on the business level and the individual level, which is also the sense or the key of corporation actually for that discussion purposes. For partnership, that's going to be like, in this sense, it is zero, because this is like before the law in the US. But in the Philippine setting, well, what we've known so far is that for the general professional partnership, wherein the partnership is organized for the practice of profession, this is going to be the case, like zero profits. However, for business partnerships, like partnerships organized for profits and for business purposes, also there will be a tax, and normally the same as corporation in the Philippine setting. So in the US, this is before, but after that, so allow me to minimize this once more. So we have the well-known corporate profits, and then there are taxes on the dividends, personally speaking. Then we also have to take into account the personal tax on partnership income. But for the partnership, of course, partnership income only here. So zero for the partnership. And then for the corporation, well, there's 35,000 for the tax for the corporate. And then there's a tax for the dividends for the shares of the shareholders. Overall, we can notice that before and after, so for partnership and corporation, it's just a matter of the percentage. So the income tax rate, whether that's for the corporate or partnership level or the individual level, could change. So you can notice that such was like 0.38 before and now 0.35. So in the Philippines, well, we have to refer to our tax laws for that. But for the partnership income, remember, we have like 20%. So that's what we have already encountered. And then for corporation, you can notice here that the steps are same. Then for that one, for the personal tax on the dividends, so that's 15%. But here before the Tax Relief Act, it was treated like at 38%. So same tax as the partnership then. So this is again US, but in the Philippines, guys, our rulings would be as a whole. For partnership, well, if general professional, no tax on the partnership level, but there is a tax on the individual level at 20%. For the corporation, of course, there is a tax on the corporate level and also for the dividends. So that's given. If the partnership is like a business partnership or organized for business, then it will also be treated similarly as corporation, that there is a tax similar to that, and also for the share. Hopefully that is clear. Then we also have the so-called in US as corporations, that shareholders are to be taxed as partners, yet they have their limited liability status. Anyway, this is for US, and the limited liability companies with S corporations limited liability, they're also partnerships. So we have to refer that in US. Then we can notice that there is a growth of stock market capitalization. So a lot of businesses are into corporations because of the limited liability concept. So we can notice here that the United States has the greatest like margin of stock market capitalization overall, which is of course because it is actually the biggest market overall. Then after that, how would the corporate financial managers' goals will have to be treated. So what should a financial manager try to maximize? This is the question that we would ask ourselves. How to maximize profit? So earnings reflect past performance rather than current or future performance. That's true for financial accounting and reporting. So we treat with historical information. The timing of the profits are ignored, cash flows are also ignored, and risks are ignored. That's the problem about financial accounting and reporting. And for the concept of financial accounting then, the concepts. Then what about for financial management and the financial manager? It has to focus on maximizing shareholders' wealth. So where can we focus? Where can we get information about that? How do we measure? Then we look for the stock prices. So we have the market prices of the firm stock. Since the current market price of the stock would reflect actually the timing, magnitude, and risk of the cash flows that investors expect a firm to generate over time. Whatever is the stock price, that is the accumulation of the changes of the values or the combination of all values all throughout the years. Then shareholders are the residual claimants of a firm. Remember, they will have to receive right after the creditors, especially for liquidation purposes. Then there has to be a focus on stakeholders in order to increase or maximize the value of wealth. So it has been noted that many firms seek to preserve rather the interest of other stakeholders such as employees, customers, tax authorities, and the communities where the firms operate. So this is very true, since it has been also noted that the more that the organization and the management would focus with the stakeholders or those people in which the decisions of the companies or businesses will be affected the most, then the more that the company can be successful in the long run, especially if they do the things right and then ethically in that sense. Doing so provides long-term benefits to shareholders and is in line with the primary goal of maximizing shareholder wealth. So overall, if we think of the long term, then you have to maximize eventually our shareholders' wealth. Long-term benefits will be the key here for the maximization or optimization of shareholders' wealth. Then another concept is about agency costs in corporate finance, wherein there has to be a value just in case that there will be problems of the agency, which is the conflict between the goals of a firm's owners and its managers. So there has to be supposedly an alignment of the owner's objectives and goals as a whole, and also the managers for their specific functions. However, sometimes the goals and functions or objectives of the managers will not be aligned with the owners. So this is the case of the so-called sub-optimization. If aligned, that's called goal congruence. I repeat, goal congruence versus sub-optimization. That is a concept in management accounting. I'm just connecting here. Anyway, if there is a conflict, then that would result to agency costs. So how do we overcome that? Then there is a way of disciplining the managers in cases that they will not perform accordingly. So as a sort of discipline, we rely on market forces. So it can be that their compensation in a way will have to be relying on market forces, which is normally beyond the control. So if they do not do their thing, then that's going to be the discipline. Then we do monitoring and bonding costs to supervise managers, meaning the organization has to spend for the supervision. Then we structure executive compensation packages to align managers' interest with stockholders' interest. So it has to be that if ever the managers are going to follow the guidelines of the organization or business, then their compensation also will go after or will be aligned with that. So it has been noted also that the actual workings of many compensation plans have been harshly criticized in recent years because such only resulted to more cases of agency problems. That's why we have these discussions in order to minimize the cases of agency or agency problems, if not totally eliminated. Then another item is for the ethics in corporate finance. So in this case, today, society in general and the financial community in particular are developing and enforcing higher ethical standards. In that sense, since we want to do things ethically, rightfully, accordingly. That's why that is the focus again of the society in general and as a whole. Then the US Congress passed the Sarbanes-Oxley Act in 2002 to enforce higher ethical standards and increase penalties for violators, as explained in discussions about corporate governance and social responsibility, that there has been a lot of problems already in the corporate setting, resulting to major corporate scandals because of certain fraudulent transactions that happened, like the fraudulent financial reporting of the Enron scandal. You can revisit, you can read summaries about such case because that is like the highly publicized and highly considered case of this. So the major corporate scandal. And the Sarbanes-Oxley Act is the act that is in response of that. To summarize, we have the following items again that we will have to revisit. The first point is that financial managers should seek to maximize shareholders' wealth. That is the first objective in corporate finance. Then the second one is how. So we perform the 5 basic duties of corporate finance as explained a while ago. Find a way to memorize these items. So external financing, capital budgeting, financial management, risk management, and corporate governance. The latter 3 items, like financial management, risk management, and corporate governance, that's something that we can actually relate to eventually and actually, like in the first hand. But the external financing, capital budgeting could be new terms. Well, that does not stop us from remembering. Then we select investments wherein the marginal benefits would exceed the marginal cost. This is our main point of our discussions. So overall, we have to make sure that the margin is positive, that the benefits will have to exceed the cost under the cost benefit approach. All right, this is our end point of our discussions for the first and the second parts of Introduction to Financial Management. Hopefully you get something from this session. Thank you very much and God bless us all.